When you think of real estate investing, you might picture house flippers or landlords handling rentals for added income. If you're keen on real estate investment but find it labor-intensive, don't worry. There's passive real estate investing. This lets you earn without the hands-on effort needed in active methods like house flipping. Wondering what passive entails and how it works? Here's what you need to know. What is passive investing? Passive real estate investments need minimal upkeep. You can invest passively through REITs, crowdfunding, remote ownership, and real estate funds. These methods allow income without physical labor or being a landlord. For instance, REITs are akin to mutual funds, offering cash from property investments without property ownership. Passive real estate investment versus active real estate. Passive real estate investments differ from active ones in key ways. Active investors own and manage properties, while passive ones avoid hands-on involvement, often without seeing the property. Active investments involve responsibilities like repairs and leases. Passive investments offer less control and potential tax benefits but are easier for beginners. They also tend to be more liquid than active ones. How to invest in real estate for passive income, tips for success. For newcomers to passive real estate investing, there are key options to consider. These include crowdfunding, REITs, real estate funds, and remote ownership. Crowdfunding. Real estate crowdfunding lets you join forces with other investors to tackle larger investments together. Typically online, this approach pools funds to indirectly invest in mortgages nationwide. Similar to investing in partial shares of stocks through online platforms, it's a way to generate passive income. REITs. REITs, or real estate investment trusts, function as property investment companies. They primarily deal with commercial real estate, distributing annual profits to shareholders as dividends. REITs manage property ownership, rent collection, and sometimes mortgage funding with interest collection. Investors can engage through public trading like stocks, often in retirement accounts. While not highly risky, REITs may not yield the same growth or appreciation as other investments. Real estate funds. Real estate funds are akin to mutual funds, investing in public real estate securities, which can encompass REITs. They offer long-term growth rather than dividends. Unlike REITs, they diversify across various property types, not just commercial ones. Managed by experts, real estate funds spare investors the need for extensive research into investment decisions. Remote ownership. Remote ownership, a form of passive investment, offers more control without full landlord responsibilities. Investors own properties but delegate upkeep to on-site managers. This suits out-of-state investors who monitor properties digitally. It taps into high-demand areas regardless of location, yet carries risk as it relies on remote management. The benefits and risks of investing in passive real estate. Passive investing offers extra income and future growth potential, though it's not risk-free like any investment. Let's explore what to expect as you begin with passive real estate investments. Passive investing benefits. Lower initial investment. Passive real estate investment is feasible with limited funds. Unlike active solo investing, where buying an entire complex might be challenging, methods like crowdfunding or REITs enable participation. Simplified expertise. Passive real estate investment doesn't demand extensive know-how. Opting for REITs or real estate funds eliminates the need to master property management. Improve liquidity. Passive investing offers enhanced liquidity compared to active approaches, freeing up your time from property management. Minimal effort. Passive real estate investment doesn't involve physical labor. You invest and observe growth, avoiding tasks like house flipping or rent collection. Passive investing risks. Less profit potential. Active real estate investing can yield higher profits, especially with tasks like fix and flip, despite the extra effort. Delegated decisions. Passive investment often involves others making choices. Real estate funds or remote ownership means others manage investments or properties, which might lead to subpar upkeep. Market volatility. All real estate investments, whether hands-on or passive, can be affected by vacancies and property value decline. Even seemingly low-risk ventures carry inherent market risks, influencing their success. passive real estate investments offer steady income without property management hassles. Yet, they may not suit all. Some investors might prefer more active options like house flipping. In conclusion, exploring real estate as a source of passive income can be a transformative journey toward financial freedom. We've uncovered the surprising pathways that can lead you there. If you're intrigued by the potential of real estate investment trusts and want to dive deeper into understanding how they work, don't hesitate to click on the video showcased on your screen. Remember, your financial future is in your hands, and the possibilities in the realm of passive real estate investing are truly exciting. Thank you for joining us in this enlightening discussion.